The cost of insuring Nvidia's debt against default just posted its biggest jump on record, and the trigger was not bad news. It was $750 billion of new deals. Also in the last 24 hours, the largest open model in history finally went live, and a Chinese memory chip maker became the most valuable listed company in China. There is no new frontier model today, so we are skipping nothing and inventing nothing. Start with the number that moved markets on Monday, July 27th. Bloomberg reported that Nvidia is working on a fresh round of artificial intelligence infrastructure deals worth more than $750 billion. The equity market did not like it. Nvidia closed at $196.51, down 4.99% on the session. But the sharper signal came from a market most people never look at. The cost of protecting Nvidia's debt against default over 5 years rose by as much as 0.14 of a percentage point, reaching roughly 0.82% a year. According to ICE Data Services figures cited by Bloomberg, that is the largest intraday increase since those swaps began actively trading in November. Now here is the part worth carrying with you, because most coverage will stop at the stock price. A company announcing $750 billion of future demand should, in a normal market, be delivering good news about itself. The credit market read it the other way, and the credit market is the one that gets paid to think about what happens if the demand does not show up. These are not purchase orders. A meaningful share of them are commitments, guarantees, and financing. When a supplier starts underwriting its own customers, revenue and risk stop being separate things. Shareholders see the revenue line. Bondholders see the guarantee. On Monday, those two groups looked at the same press release and moved in opposite directions, and that divergence is the real story of the day. To models, where the thing we flagged as scheduled yesterday has now actually happened. Moonshot AI's Kimi K3 open weights are live on Hugging Face, along with the full technical report. So here are the real specifications, taken from the model card rather than from launch coverage. 2.8 trillion total parameters, with 104 billion activated per token. 93 layers, split as 69 Kimi Delta attention layers and 24 gated multi-head latent attention layers. 896 experts in the mixture, 16 of them selected per token. A context window of 1,048,576 tokens. Weights ship quantized in MXFP4 with MXFP8 activations. Reported benchmarks include 93.5 on GPQA Diamond, 88.3 on Terminal Bench 2.1, and 91.2 on BrowseComp. The claim in the technical report that deserves more attention than the benchmark table is this one. Roughly a 2.5 times improvement in overall scaling efficiency over Kimi K2. That is not a leaderboard number. It is an economics number. Benchmarks tell you what a lab could build once. Scaling efficiency tells you what it can afford to build repeatedly. Within hours, the Hugging Face page passed 1,200 points on Hacker News. For context, that is more attention than most closed frontier launches get. And there was one genuinely new model release on Monday, though it will not appear on any general-purpose leaderboard. Microsoft introduced MAI Cyber 1 Flash, described as a compact, code-heavy security model derived from the MAI Thinking 1 lineage. It is built to find vulnerabilities in complex code bases, and it is not being sold as a standalone model. It ships inside MDASH, which Microsoft describes as a multi-agent vulnerability identification and remediation harness running more than 100 agents configured by security experts. On CyberGym, the benchmark used for vulnerability discovery, Microsoft reports the combined system reaching 95.95% and says the new model alone runs 12 points above Mythos. The number in that announcement that says the most about where this industry is heading is not the accuracy figure. It is the cost structure. Microsoft says the harness routes roughly 90% of tasks to the small model and reserves expensive frontier models for the remaining 10%. delivering the result at about half the cost of leading models. That is a quiet admission with broad consequences. The competitive frontier is shifting from which single model is smartest to which routing architecture spends the least to reach the same answer. And routing is a much harder thing for a rival to copy from a benchmark table. Now the largest single move by any company anywhere on Monday, and it did not happen in America. Chongqing Memory Technologies, CXMT, headquartered in Hefei, made its debut on Shanghai's Star Market. It priced at 8 yuan 66 per share. It opened above 49 yuan. The gain was roughly 470%, with CNBC putting the debut figure at 466%. That took the company's market capitalization to around 3.3 trillion yuan, roughly $480 billion, making CXMT the most valuable company listed in mainland China, overtaking Industrial and Commercial Bank of China, which has held that position for years. The offering itself raised 57.92 billion yuan, about $8.6 billion, the largest exchange listing in mainland China since Agricultural Bank of China went public in 2010. CXMT makes DRAM, the ordinary memory that sits alongside every AI accelerator. Here is the detail that explains the price. CXMT held about 7.67% of the global DRAM market by late 2025, a minority player. But Samsung, SK Hynix, and Micron have all been shifting capacity toward high-bandwidth memory for AI servers, which has left general-purpose server DRAM badly undersupplied. CXMT is one of the few firms still making the boring product in volume. The market did not price a technology leader on Monday. It priced a bottleneck. Back to the $750 billion figure from the top of the show, because the pieces underneath it matter more than the total. The larger component is a partnership with South Korea's SK Group, unveiled late on Friday and valued at more than $500 billion. It runs in both directions, Nvidia spending on memory chips and SK buying Nvidia supercomputers. It also includes building more than 2 gigawatts of AI data centers on the Korean peninsula, with the first facility due to open next year through SK Telecom. The second component is the one still in motion. Nvidia is reported to be in talks to guarantee as much as $250 billion so that OpenAI can lease a 10-gigawatt data center SoftBank is building in Ohio, a campus reported at around $500 billion in total. Separate reporting puts a further $350 billion of OpenAI chip purchases under discussion for financing. Those talks are early stage and could collapse. We are reporting them as reported, not as done. Gary Tan of Allspring Global Investments summarized the pattern plainly. Capital is increasingly being used to fund future AI customers and infrastructure deployments. Note what the Korean half means in isolation. 2 gigawatts of Korean data center capacity, plus a memory buying commitment lands in the same country whose memory industry is being reshaped by the very shortage that just made CXMT the most valuable company in China. These are not two separate stories. They are one supply chain, being financed from both ends at once. A smaller item now, which we are including because it is verifiable and because nobody is covering it. Anthropic's status page logged 2 separate incidents on Monday, both titled Elevated Errors on Claude Opus 5, both affecting Claude.ai, the API, Claude Code, and Claude Cowork. The first opened at 0816 UTC and returned to baseline at 0905. The second opened at 1127 and cleared at 1147. Those follow the 87-minute incident on Sunday that we reported yesterday. That is 3 logged incidents on the same model in roughly 36 hours, on a model released on Friday, July 24th. We want to be precise about what this is and is not. Total downtime here is well under 3 hours, and every one of these was disclosed and resolved quickly, which is, genuinely, the system working. But there is a pattern worth naming, and it is not specific to Anthropic. Frontier models are now being shipped into production traffic within days of release, at a moment when that traffic includes coding agents running unattended for hours. The failure mode of a chatbot outage is an annoyed user. The failure mode of an agent platform outage is a half-completed job with no one watching it. As labs move from selling answers to selling autonomy, uptime stops being an infrastructure metric and starts being a product feature. One more from the corporate side, and it cuts against the story this industry has been telling about itself for 2 years. The Wall Street Journal reported on Monday that after a year of holding back, large employers across technology, transportation, and defense are saying they need more people to work alongside artificial intelligence, not fewer. Companies from the railroad operator CSX to Google parent Alphabet have told investors in recent days that they plan to hire, either to meet growth targets or to move on emerging technology. Some executives cite the costs and limitations of AI as the reason more people are needed. Others are rehiring after layoffs. The specific reversal in that reporting is the sharpest part. Many companies stopped hiring entry-level staff on the assumption that agents would absorb the work, and have since concluded that humans are required to work alongside those agents. Treat this carefully. It is one report, at one point in a cycle, and hiring plans announced to investors are not the same as hiring. But it is the first broad corporate signal running against the automation narrative, and it arrives from the same executives who set that narrative. The interesting question is not whether AI can do entry-level work. It is who checks the output when it does, and what that person needed to learn first. To Washington, where the second quarter lobbying disclosures have now been fully tallied, and the Financial Times analysis of them circulated widely over the weekend. 11 of the largest technology, social media, and artificial intelligence companies, together with their leading trade associations, spent a combined $41.8 million lobbying the federal government between January and June. That works out to more than $230,000 a day. The individual lines are where the direction of travel shows. OpenAI spent a record $2.22 million in the first half, close to double the same period last year. Anthropic spent $3.53 million, close to triple. Alphabet reported $5.3 million in the second quarter alone. Microsoft spent about $3 million between April and June, and Nvidia $1.25 million. Now the interpretation, because the raw totals are not actually large by Washington standards. Pharmaceutical and defense lobbying dwarfs these figures. What is unusual is the growth rate and who is producing it. The steepest increases are coming from the two companies that are least established and most exposed, OpenAI and Anthropic, neither of which existed as a lobbying presence 4 years ago. Chip export rules, safety regulation, copyright liability, and antitrust all now sit close enough to their business models that Washington has become a line item. Doubling and tripling year over year is not the behavior of firms managing a policy risk. It is the behavior of firms who expect the rules to be written soon. And the story that drew the single largest wave of attention across technology forums in the last 24 hours is not a launch, a funding round, or a regulation. It is what happens to books. A post on Sunday, July 26th, from the account Hedgy Markets recirculated an ongoing practice, and it climbed to roughly 700 points on Hacker News. Artificial intelligence firms have been bulk buying old and out-of-print books by the pallet, running them through high-speed scanners that cut the spines off and destroying the originals. A cataloging service called ISBN-DB facilitates orders reaching into the millions of volumes and keeps the buyers anonymous. The stated logic is precise. Books printed before 2022 predate the large language model era, so their text is guaranteed not to contain machine-generated writing. Clean data has become scarce enough to be worth industrial effort. The legal position is settled, and it is the uncomfortable part. United States courts have found that scanning purchased physical books for training is fair use, partly on the reasoning that destroying the original means only one copy exists at any time. The same court process that approved Anthropic's $1.5 billion settlement over pirated books drew that line clearly. So this is lawful. What it is not is reversible. Rare, foreign language and low circulation titles that were never digitized anywhere else pass through the scanner once and then physically cease to exist. The model retains the text. Nobody retains the book. That is a trade the copyright system was never designed to evaluate, because until now, reading something has never consumed it. To the market board. Every price here comes from live market data at Monday's United States close, the most recent completed session, and nothing in this segment is investment advice. Monday was not a down day for artificial intelligence. It was a day when artificial intelligence stopped trading as one thing. On the semiconductor side, Nvidia closed at $196.51, down 4.99%. AMD closed at $494.95, down 5.17%. ASML closed at $1,655.26, down 5.80%. Micron closed at $900.20, down 2.25%, and Taiwan Semiconductor at $399.09, down 1.07%. Now the other side of the same session. Microsoft closed at $389.10, up 1.94%. Alphabet closed at $326.56, up 2.13%. Oracle closed at $119.90, up 4.27%. Palantir closed at $131.53, up 7%. Apple closed at $336.91, up 1.17%, which is why the index numbers look almost boring. The Nasdaq Composite closed at 24,932.08, down 0.18%. The S&P 500 closed at 7,413.18, up 0.02%. Two indices essentially flat, sitting on top of 5% moves running in opposite directions underneath. That is the observation worth keeping. For most of the last 2 years, buying anything with artificial intelligence attached behaved like a single position. On Monday, it split cleanly along one line. Who pays for the capital expenditure and who merely rents the result? The companies that must build, buy, and finance physical capacity fell. The companies that sell software on top of somebody else's capacity rose. Some context on the mood from the other direction. In a MacRumors interview published Monday, the technology critic Ed Zitron argued Apple is positioned to sit out a downturn, saying he thinks they will sit on the sidelines and watch everything burn. He contrasts Apple's roughly $14 billion of spending with hyperscaler infrastructure budgets he places above $650 billion a year. Those are his figures and his argument, not ours, and he is a declared skeptic. We include it because on Monday the credit market and one of the loudest bubble critics happened to be pointing at exactly the same variable. Not demand for artificial intelligence, but who is carrying the cost of building it. Finally, what to watch, and everything in today's episode converges on one date. Microsoft and Meta are both scheduled to report on Wednesday, July 29th. Microsoft has guided to roughly $190 billion of capital expenditure for fiscal 2026, and across Amazon, Alphabet, Meta, and Microsoft, the combined figure plan for 2026 is around $725 billion, up roughly 77% from about $410 billion the year before. Analysts have also flagged that elevated memory and component pricing is expected to compress operating margins, which connects directly to the memory shortage that repriced CXMT on Monday. So here is the specific thing to listen for, and it is not the earnings per share number. Monday's session said the market has started separating companies that fund capacity from companies that rent it. Wednesday is the first time since that split that two of the largest funders have to stand up and defend the spending out loud. Watch whether they raise the CapEx guidance, hold it, or start describing it in terms of returns rather than ambition. Watch also whether either one is asked about the cost of financing it, because that is the question the credit market asked Nvidia on Monday and got an answer it did not like. Beyond Wednesday, the first independent reproductions of Kimi K3's benchmark numbers should begin appearing now that the weights are public, and independent verification is when a launch claim becomes a fact. That is the day. One company announced $750 billion of business, and its debt got more expensive to insure. Another company that makes ordinary memory chips became the most valuable listed business in China. The largest open model ever released went public without a press conference. And a scanner somewhere finished another pallet of books. Everything in this episode is sourced in the description. Every price came from live market data at Monday's close, and nothing here was investment advice. We skipped the products section today because nothing shipped in the last 24 hours that was worth your time. We would rather run short than pad. See you tomorrow.